Bridget, very good to see you. An important topic today, how to reduce taxes in your portfolio. A lot of people watching have probably heard about asset allocation before, but just as important is asset location, where you keep your assets. In a tax advantaged account or a traditional brokerage account can significantly lower the tax bite in your portfolio. So let's start high level. Can you please talk through the benefits of investing in a traditional and a Roth IRA and how each has its own unique tax advantage?
Great. Yeah, that's a great question. Everybody's heard of IRAs and Roth IRAs both, but a lot of people are still fuzzy on exactly what they are. The way an IRA works is if you contribute $1 to an IRA, that whole dollar is tax deductible, and then it earns tax deferred, so you don't pay any taxes on that principal or on the earnings that it makes the whole time it's earning until you take that money out to spend it in retirement.
Mm-hmm.
Conversely, a Roth IRA, if you put $1 into a Roth, you're going to pay the tax up front. So say you pay 15 cents tax up front, you're going to invest 85 cents. But that 85 cents and all the earnings on that 85 cents is tax-free forever, even when you pull it out to spend it.
Yeah, that's
so
really
you avoid the future tax implications on that.
Mm-hmm. All right, next you suggest that we consider tax loss harvesting. Can you explain how this one works, please?
This one's a little more advanced, and this
Yeah.
is only for non-qualified accounts, like an individual brokerage account. You can't do this within an IRA or a Roth. It just doesn't work the same way. But in an individual account, the way this works is we systematically sell off positions that are not performing as well, and that creates a loss, obviously. Well, that counts as a capital tax, long-term capital gains loss, okay, if you've held the stock for over a year. So what that means is that when you have another stock that's performing well, let's say you have Apple, and Apple's going to take a little dive, we can tell. So we sell Apple and lock in all the earnings that we made on that. Well, those earnings that are a gain are offset by the previous losses that we booked for you. So you have no capital gains tax because they're washed out to zero, and now there's no tax on it.
Mm-hmm. All right, now let's drill down a bit more into asset location. Dividends and other cash distributions are typically taxable in the year that you receive them. To minimize your tax burden on dividends, consider where you hold your investments. What do we need to know?
Well, again, it's all strategic on how you want to pay the taxes and when you want to pay the taxes. Dividends by nature are taxable every single year, just like the interest earned on a position is taxable every single year in a regular account. So if you want to stall those out and pay them later, you could put them within the IRA or the Roth, and then you could have the compound interest on those dividends growing over time. So that when you take it out, yes, you pay the tax on it, but you have the benefit of all that compound interest.
Mm-hmm. And then next, you suggest taking advantage of long-term capital gains tax rates. With strategic and very proactive planning, there is a potential for a 0% tax rate.
Absolutely. We do a lot of this at Riley Higgins. So when you're in your earning years, accumulation years before you retire, we're strategically repositioning your assets to get as much as we can over into that Roth, because as you can see by this chart, the more money that you make in income, the more tax you're going to pay on your capital gains earnings as you take your money out of retirement, out of your non-qualified accounts. By having it in the Roth, you avoid that. Now, we are at a historically low tax rate right now, so we want to try and get as much as we can into that Roth as quickly as we can so that you don't have to ever think about it in the future.
Right, which is why you and I are also talking about Roth conversions all the time.
Exactly.
Right, but the key is, again, proactive planning. You need to start, putting that plan together now, which I know is what you specialize in, Bridget. So if somebody would like to talk with you to figure out how to reduce taxes in their portfolio, what's the best way to reach you?
Well, you can call the office at 480-581-8545, or you can reach us at our emails, Bridget@RileyHiggins.net or Frank@RileyHiggins.net.
Perfect. All right, Bridget, thank you so much for your time today. I really appreciate it.
Thanks, Erin.